Hi and welcome to Penser Bank. My name is Markus Almerud. I'm an analyst here at the bank. Today we're here to talk about Lagercrantz. So Lagercrantz is an acquisition-driven technology group with about 70 decentralized subsidiaries. Each subsidiary targets to be a leader in its specific niche. Its largest end market is power distribution, followed by infrastructure. We have a fair value range of 133 to 135 Swedish krona, and the share is at 112. So the investment case in short is that Lagercrantz is a compounder with a long track record on making acquisitions. We've seen M&A activity accelerating in recent years. We see potential for accelerated organic growth. We see further margin expansion, and hence we see the potential of doubling profits again in the coming 5 years despite them just doubling. So what is a compounder and what are the drivers? Well, a compounder is a company that makes acquisitions at multiples lower than themselves and doing this over and over again. M&A has historically accounted for 2/3 of Lagercrantz sales growth, and it is the most important growth driver, and I cannot enough emphasize this. Looking at the margins, they have expanded in an impressive way. They have increased the share of proprietary products. We've seen general improvement of subsidiary results. They have made margin accretive acquisitions, and they have raised margins in acquired units. But we think there is more to go for. Looking at the units themselves, there is still a number of units which is far below the company average. So more to go for in terms of margins. So what is the room for acquisitions? Well, the interest rate has come up, and focus, we think, is on cash flow. Self-financed growth will be worth a lot more than debt-financed growth. Lagercrantz has improved cash flow generation structurally by improving the margin over the past 5 to 6 years. And looking at how much they have spent about 140% of cash flow after dividends on making acquisitions. They do have the strongest balance sheet among peers. If they use internal funds, and if they expand the balance sheet in line with what they've done historically, that is, they use about 140% of cash flows after dividends, they will be able to double earnings again in the next 5 years. Looking at the debt at that level, they will have a net debt to EBITDA at 1.3 times in 5 years. Were they to raise this level to 2 times, they would add another 10 to 15% of earnings. We think that a strong balance sheet will allow for higher growth, and Lagercrantz sticks out from this perspective. So what is the resulting upside here? Well, we believe in an EPS of almost 8 kronas in 5 years. That is up from 3.7 in last year. If we put the P in line with the historical average on this, we get a value after discounting of 134 kronas per share, with another 15 if the balance sheet is maxed. However, I think it's worthwhile pointing out here that in 5 years we will see a value of 174. Why does it make sense not to discount in this particular case? Well, because we will constantly move valuation forward, and this is a long-term growth case. A couple of words on how Lagercrantz compare to peers. Well, we do see among the best margin expansions among peers. We see among the highest margins among peers. But most importantly, as we mentioned, they do have the strongest balance sheet among peers. So in summary, Lagercrantz has a superb history. We think that they will accelerate going forward. We think that the finances allow them to at least double earnings over the next 5 years, despite just having doubled. And they have the strongest balance sheet among peers, allowing for faster growth. Thank you.